right, you'll be good to go.
Yeah, for those of you who are on the phone, I'm going to do a quick introduction. Dave's the legend who followed at Finley Davies back in 2000. After he left Finley Davies, he spent some time at Buck Consulting and then decided to go out and start a new career in the investment advisory world, and is a certified financial planner, and has his own company, and has written a paper that anybody who's in the defined contribution space should be interested in. So, Dave, thank you for coming over, and
thanks, Neville.
I look forward to listening to you.
Thanks, Neville. Thanks for coming in today. Thanks for hosting me to present my new concept in financial planning. It's falls to the category of dynamic withdrawal strategies, which may not mean a lot to you, but hopefully by the time I'm done, it means a little more to you. Before we started, I would go over a little housekeeping. First, if you don't understand something, feel free to stop me and ask questions, but if you have other questions, hold them to the end. It's a bit of material. I have been through it before. I don't know exactly how long it's going to take me, but I think I'd like to breeze through the material and then answer any questions you might have. For my compliance attorneys, I need to say that this is an educational and informational presentation, and in no way does it mean anything, does it constitute personalized investment or professional advice. Before I tell you about the target percentage, I have to give you a little background about the 4% rule. How much you heard about the 4% rule, or I'll tell you there's a lot of misconceptions about the 4% rule. But my mission today is to dispel those misconceptions up front. In 1994, a gentleman named Bill Bengen posted an article on the Journal of Financial Planning. He published an article in the Journal of Financial Planning. But before I get into that, I'll tell you the most important question that clients ask me as a financial planner is, am I outlive my money? Or maybe better yet is, what can I do to make sure I don't outlive my money? Or if a little farther, they might say, how much can I withdraw from my portfolio each year and outlive my money? That's probably the best question. And Bill Bengen took a step at answering that question. It's a difficult question. It's an important question, but it's also a difficult question because nobody has an answer. You have to be able to predict the future. And, we all know how good we are at doing that. So what Bill Bengen did, he published an article in Financial Planning. It has since become the gold standard. Every financial planner says, withdraw 4%. That's the rule. It's become a hot topic. It's become a very hot topic. But even 3 or 4 years ago, a lot of researchers were saying 4% is too high. I know it's too low. When he first published the article, it was criticized as being too low because returns were way greater than that. People were saying, gee, that's ridiculous. You could certainly withdraw more than that. In fact, just this week there was an article in the New York Times. There was a section, a retirement section, and they pretty gave the first. They looked like they attended my seminar here for the first 10 minutes because they gave a synopsis of the background on the 4% rule. But for those who are not yet retired, you might think that 4% only applies to retirees, but that's not true. It also applies to pre-retirees in the sense that it defines how much you need to save in order to retire. So, for example, if it's 4%, if you believe that 4% is the safe withdrawal rate, then you want to have 25% of that, or 25 times that retire. But if you think it's 5%, then you only have to have 20 times that, and et cetera. Well, I realized that Bengen's methodology, a lot of people think that the 4% rule means, oh, you just take 4%. Next year, you take 4%. Well, but that's not the way Bengen wrote his article, and that's not the way all the articles are written that way. The concept is you take 4%, and then you increase or decrease that with inflation or deflation as time goes on. So it's kind of Social Security. You know, you start with 4% is the initial safe withdrawal rate, and you go on from there. So what Bengen did was he looked backwards in time at capital markets historical data, and from that he took as many 30-year samples as he could find. And the 30 years is the period of retirement. And he found, back then it was, back to 92, he found 37 samples, projected them to his analysis. He looked at, 2%, 3%, 4%, 5%, 6% to see, which ones, which withdrawal rates would survive in each of these scenarios. And for his analysis, he took the EBITDA data, 50% large cap stocks, which is essentially the S&P 500, and 50% intermediate term government bonds. And he found 4% to be the highest rate that survived all those periods. The picture tells 1,000 words. So this is a graphic illustration of his paper. Okay, so you can see that the lowest bars touch the 4% line. So a lot of people think that the 4% rule is an average. It has nothing to do with an average. 4% is the worst case scenario. Okay, so all these periods, 4% would have survived the worst case scenario, which happens to be 1969. Now you probably have thought 1969 would have been the way to retire, but it was. You could see there's another dip I'm going to get into later. 1937 is a dip. Take a look at 1983. You could have withdrawn about 0.5% a year for 30 years, and you could have survived. So on average, it's about 6%, let's say 6.5%, that you could survive. Now watch the graph closely. I'm going to switch the portfolio mix. Okay, I just switched from the S&P 500, 50% large cap, to something that simulates the total stock market, which would be 5% large cap, 15% small cap. And you can see it got us another about 0.5%, maybe 3/4, in order to 0.5%. So that's the portfolio that I used in my paper, by the way. That's also the portfolio that Bengen used in his later work. He realized that it made more sense to throw in small caps. So this has been a very hot topic. A lot of articles that have gone into popular press, not just the scholarly journals. But there's an article that's gotten a lot of press lately. I think of it is the phone is no longer safe in a low-yield environment. You may have seen articles in the Wall Street Journal on that article, that paper. What the paper argues is that there's a perfect storm ahead for withdrawal rates. The environment is primed for a perfect storm. Number one, we have low bond yields, which are going to suppress portfolio returns. Number two, they argue that equity valuations are relatively high. Price-to-earnings ratios, which portends lower returns over the next 10 or 15 years. And called sequence risk, which we'll get into in a little bit, namely that the worst thing that can happen to you is if you have bad returns in the first years after you retire. If you have returns in year 20 or 25, doesn't make a big difference. It's the first couple of years after retirement. That's called sequence risk. So researchers are very pessimistic, obviously, the authors of that article. Others not so much. Somewhat neutral. I think that it's at a certain point you start getting into predicting the future, and nobody's very good at that, particularly not college professors who write papers. and maybe they should stay out of that. But nonetheless, there is a consensus that 4% may not be as safe as it once was. And consensus is that planners and clients should monitor their portfolio status going forward and better to take reductions in your future withdrawals to sustain long-term portfolio survivability using sort of dynamic withdrawal strategy rather than a static withdrawal strategy, which is what Bengen and all the researchers, not all the other researchers, but the vast majority of other researchers have done. So that's kind of where the current research leaves us. So the question is, how do you do that? Okay, what method do you use to monitor your portfolio health? Well, I'm in the financial planning space, and I couldn't find one. So I came up with the target percentage. Okay. And now that you have the target percentage, what strategy should you use when the target percentage indicates that your portfolio is in danger? The metric's breached, and I came up with the target percentage adjustment. And when I wrote the paper, one of the things you do when you write a paper like this is you research all the other papers to see if anybody else has done something along these lines, and then you have to compare what you've done against the others. Well, about 10 papers that had some sort of dynamic withdrawal strategy that worked the way mine did. I eliminated most of them because they reduced your withdrawal from the prior year. So I decided not to consider those because anybody that works with financial clients know that that's a pay cut. Like asking people to take a pay cut. Okay, it's easy for a researcher to do. Go, oh, your portfolio survived. Just take a % less than you took last year. Yeah, try and tell it to a client. You can tell that from your college professor right tower place, but try and tell it to a client. So I focus on inflation. So in Bengen's model and all the other researchers' models, they assume that the will be fixed with inflation, and that's kind of guaranteed. And the concept there is that you maintain your purchasing power throughout retirement. That you take out the same on a real basis, real dollars, as you did in the first year. However, and I cite some studies in my paper, argue that as people grow into their retirement ages, particularly 70s, 80s, they don't spend as much as they did in their initial years, so they afford to flex a little bit on the inflation side. This is a table from my paper. This sets up the analytical framework, and but what it shows is what would happen if I took something less than inflation as my increase each year. Okay, so the first set of lines, the first 3 lines, show if you took it was Bengen's methodology. If you took the full CPI increase, and 30-year retirement, 35 and 40-year retirement, because 30 was a little short. These are the results of Monte Carlo simulation. It's the same Ibbotson data. I'll talk a little bit about my assumptions in a minute. Basically, my studies show that these are the 95% confident withdrawal rates. So if you take a 3.9% withdrawal from your portfolio, invested the way I've assumed you've invested it, there's a 95% chance that you will not outlive your money, that you will have a successful retirement. You will make it to the end of 30 years with at least $1 in your portfolio. It's down a little bit for 3.6. For 35 years, it's 3.6. For 40 years, it's 3.4. And at the end, your withdrawal in the 30th year, we on an inflation-adjusted basis, 100% of what you took out in the first year. You'll have no loss in purchasing power. So that's kind of the analytical framework. So if you decided that you wanted to take the CPI less 1%, so I'm not going to go the full CPI, I'm going to take a little bit of a haircut, I'm going to take 1%, you usually increase your withdrawals by 10% over 30. So you can increase your withdrawals up to 4.3%, which is a 10% increase, and still a 95% expected success rate. But with a loss, a little purchasing power. you're on a real inflation-adjusted basis, your 30th year withdrawal would be 80% of your original withdrawal, with 19% loss in purchasing power over 30 years. And the rest of the table goes down. If you look at the no CPI increase line, you actually take over 30 years a 6% withdrawal, never get an inflation increase. You would suffer 4% loss in purchasing power, though. That's almost a 2/3 loss in purchasing power. So everybody follow that stuff? Okay, so the concept is, if you only look inflation in the good years, if or reduce inflation, the increase in the bad years, based on some measure of portfolio health or survivability, take higher withdrawals without increasing your probability of failure. So that's how I developed the target percentage. So this is half the table. I got the other half on the next slide. It's too big to fit on one slide. Yeah, good. Yeah. So this, now the target percentage, you can set up your target percentage however you want. There's an infinite number of ways to set the target percentage. Basically, you need those three assumptions at the top: your initial withdrawal rate, your inflation factor, and your portfolio return. And you start with the portfolio. It doesn't matter what the portfolio is, because the objective is to come up with the last column, which is the percentage withdrawal rate. So I started with $1 million, nice round number. I take out 4%, which is $40,000 a year. I'm assuming for those I'm assuming withdrawals at the beginning of the year. So $58,560 is 6.1% interest on $960,000. Okay, and that's a 4% withdrawal rate. And then I just, for the second year, just the simple math, I subtract the withdrawal, I add the income, and you have $1,018,560 at the beginning of the second year, and it works the way down the table that way. So I took a look to see, if I had some static set of assumptions that were realized, what would have a withdrawal rate? And as you get, it doesn't stay at 4%, it climbs. Okay, climbs gradually. Okay, and by 23 years, I picked 6.1%, by the way, to sustain the portfolio over 45 years. So 23 years is about the halfway point. I'm up to 6.06%. You can see also the portfolio is expected to rise initially. Okay, but it peaks out right about year 22. Okay, so it's the bottom half of the table. You can see the portfolio starts to decline and exhaust at 45 years. The portfolio hits about 10% year 33, 34. So that's the target percentage. And what that provides, that we haven't had before in financial planning, is a glide path for your withdrawal rate throughout retirement. Provide benchmark for success, okay, to know whether you're meeting your goals during retirement. And it also adjusts for all factors, okay, or as we say in employment, gains and losses. So whether it's portfolio return or inflation, or you decide to buy, a boat, it flexes each year for all those things. That percentage adjustment would apply when you don't fail the target percentage test. Okay? So that would be when it's a little counterintuitive. When your target percentage when your actual withdrawal percentage from your portfolio exceeds your target percentage, you fail the test. So it's a little counterintuitive. If your current portfolio rate is below the target percentage, you're healthy. You can take the full inflation increase. If it goes over, you have to start taking action to sustain the survivability of the portfolio. Okay, I'll talk about my Monte Carlo simulations. It's basic Monte Carlo simulation, standard stuff. It's based on this is the one I use from paper. It's on the Ibbotson data up to 2011. As I said before, 35% large cap, 15% small cap, 50% intermediate term government bonds. inflation, whatever, the CPI is. I did 50,000 iterations, which is economic scenarios. I like to think of Monte Carlo simulations. See, Monte simulations, basically I use the same data Bengen used, if you think about it. It's really the data. Okay, I do Monte Carlo simulations as putting the data through a blender and smooth out. And that enables me to get these percentiles. So it enables me to get some granularity in terms of evaluating the different techniques. So that's why I really kind of resisted doing it because it's a lot of work. But at the end of the day, I realized in order to prove my concept, I needed to go to Monte Carlo to get granularity to prove concept. And in their simulations for the annual withdrawal, for the Bengen stuff, I just assume that everybody's inflation. For the target percentage stuff, I assume that we reduce it by the target percentage adjustment, if applicable, in each economic scenario. Now, here's the results of the target percentage adjustment. So you can see the blue group of simulations, the same as the previous table we looked at. It's the same stuff. But if we take a 1% reduction to our withdrawal rate, in which the target percentage test has failed, we get a 10% increase in our withdrawal rate, and be just as confident, 95% confident, that we will not outlive our portfolio. And expected loss of purchasing power is only 2%. Okay, so that metric I use, and I use this same metric to compare it to other techniques in my paper. You can see the target percentage is a pretty powerful technique. Now, if you take it full boat, if you take it all the way to the bottom, target percentage with full adjustment, you could increase your withdrawal about 40 to 53%, about 50%, and you would only expect to see maybe a 12 to 17% reduction in your purchasing power over 30 years. So that's dramatic. So that's a nice theory. So I'll take it one step further, and I'm going to road test it. I didn't do in the paper, so this is a debut of this new approach. Okay, so this is a graph. They'll take get your head around this graph. The line is your portfolio, okay, and the red line is your annual withdrawal. The scale for the green line is on the left. The red line is on the right. Okay. So we saw with this is a different target percentage. Like I said, there's an infinite number of target percentages. What I did here was I said I'm going to use a 5.5% withdrawal rate, 3% inflation, and I chose 7.2% portfolio returns because that's the return that will sustain my portfolio over 3 years. Now, that's what this is. What's nice about this graph is that this on the left is 10 times the scale on the right. So lines cross, that's a 10% withdrawal rate. Okay? So I don't have the withdrawal rate on this graph. I just have the portfolio and the withdrawals. Okay? So back and revisit this. These are my samples. These are my 58 samples. The last year we have data for is 1983. Done just ended the year December 31st. I'm gonna test, put the pedal to the metal a little bit, and test the worst 2 years. The worst years, not well, 16 and 37, 1969, 1937. Now, granted, there's a couple of years in the 60s that are actually worse than 37, but they look a lot like 1969 anyway, so they don't do much. So that one with the nice curves you saw before, that's the last curvy line you're going to see. Okay. This is 1937. This is what would have happened if you just used Bengen's approach. But you use 5.5%, because I'm pushing it here. Okay. You would have crashed and burned in about 20 years. Okay. So you can see what happened back then. 1937 was a bad year. Okay, you can see the portfolio declined significantly, and now we're talking about the sequence risk. Okay, if you have bad returns in your first few years of retirement, it's like to climb uphill to get back. You know, it's almost impossible. And then we see, that the portfolio rebounded a little bit in the early 40s, but it just couldn't sustain itself and crashed and burned about 1958 or so. Now, this would have looked like if we took target percentage adjustment. Okay, so the lines are the same as the previous slide. The lit lines are the target percentage adjustment. So you can see that early on, we would have started to take those 3% haircuts annually. You don't see the red line and the line diverge until 1941, but that's just the graph. I mean, we were taking those before, and you see that we're taking lower withdrawals. But when the portfolio recovers, we start to take the inflation increases again. You can see that flat lines at about in the 1940s, the thin red line. But then when the portfolio recovers, we start taking inflation increases again, and then we're cutting back. And that little bit over long periods of time allows you to sustain the portfolio over 30 years, and you actually have $250,000 at the end of 30 years. Okay. Now, as a guideline, this blue line, which is the 4% line that you would have taken that under Bengen's approach. So that's 4% inflation-adjusted withdrawals. Okay, so that's what you would have taken if you started out with $40,000, inflation adjusted it every year, which would have sustained itself over 30 years. And actually, the two want to cross over in the middle. Keep in mind, this is a worst-case scenario. Okay, most cases, the blue line and the thin red line won't ever cross. Okay, in most cases, you won't need to take the withdrawal adjustments. Okay. Now, this is interesting. I'm going to go to 1 year later, 98, 5% withdrawal, no problem. Okay, that's the sequence risk. So this has 29 years, the same as the previous scenario. Okay, but we took out one bad year. Okay, it's leading. Okay, because if you waited 1 year to retire, because if you had $1 million of portfolio in 1937, you probably didn't have $1 million at the beginning of 1938. Okay, so that's a little misleading that way. But nonetheless, it illustrates the point that the sequence is very powerful. Okay, and we see that we would have started taking under the target percentage approach, 3%. We are taking a little bit of haircuts. Looks like the early when we had that downturn in the 30s, at the early 40s or so. But they would have picked up, and we wouldn't have had to take any more target percentage adjustments after that. Keep in mind that this is a dynamic withdrawal strategy, meaning that the idea is that you monitor what's going on. And I've got it set on autopilot, okay, because that's the way you projections. So clearly, as you got halfway through this retirement, you got up to 5, 6, to 8% or whatever, not have a problem. You would have satisfied the target percentage test, so you wouldn't have a problem. But that's the way the illustrations work, and what your 4% inflation-adjusted withdrawals would have been. So this is what most scenarios would look like. I'm just focusing on the worst case because that's what the 4% rule is all about. Here's 1969. We have here is the inflation of the 70s, the steepness of the red curve. Okay, and crash and burn about 19 years, something like that. Just probably cannot sustain those inflation increases. This is a percent target percentage adjustment. Would have taken some inflation haircuts along the way, but not only would we have sustained our portfolio, but we would have ended the 30 period with $1 million. And this is what the 4% would have given us, 4% inflation adjustments. Okay. Now I'm really going to push it, okay? Now I'm really going to push it. I'm going to take 6%. I'm going to take a full inflation adjustment, okay? I'm really going to push this thing, see where it goes. Basically, you would have taken hardly any inflation increase. You probably would have come somewhere in the middle of that and said, gee, I'm not in too bad shape. You wouldn't have been on autopilot. And 4% would look like. 1938 would look like. And you went through the chart. You obviously could have taken all those target percent adjustments. You need to, certainly not to the latter half of the projection period. And there's 4%. Okay. This is 1969 with a 6% withdrawal. Pulling through the roof, so again, you could have adjusted, but you would have succeeded. You would run out of money, and there's your 4% line. So, I made it too much than I thought I would. In conclusion, market percentage is a simple benchmark that serves as a path to monitor portfolio health during retirement. I don't think we have one of those in the financial planning world yet. That's my contribution. Planners can increase the sale rates known in the research by 40 or 50%. And as long as they take inflation increases, they skip inflation increases when the target percentage exceeded. A little less if you don't want to skip the whole increase, but just take a increase. And the way it accomplishes it, there's no free lunch. Does it work? Well, what I'm doing is I'm using the fact that 4%, worst case scenario, very conservative. It's got a margin built in for the worst case. So what I'm saying is, rather than taking this inflation increase unconditionally all the time, if we shifting the risk from failure to purchasing power. I'm shifting some of the failure risk to purchasing power. If you're willing to risk a little bit of your purchasing power, you can run more of the failure risk. Or you could increase your withdrawal rate and get to the same failure risk by using the mark there in the other area. So 0.6% to 6.6 to 6% becomes the new 4%, and 4.2 to 4.5% becomes the new 3%. So depending upon what your perspective is on the current research, if the 3% is 1 today, then, well, it's now 4.2 to 4.5 if you take a little purchasing power risk. And that's it. Any questions?
And pardon my ignorance, but percentage adjustment of when you say 3%, that means if inflation is 5%, you only give an adjustment of 2%. Is that correct?
That's close to what I did. That's the way I originally designed it. Okay, I did the paper. I changed it because one of the other researchers had done it a little differently and to do apples and apples with that research. The difference is that what I'm doing is taking the 5%, I'm taking 87% of that. Okay. So I'm taking a 3% reduction on the gross, then just lower the CPI.
If, take that same example, but if inflation is 2% in a figure, and you do a percentage adjustment of 3%, what do? You
take the same withdrawal you took last year, which is basically no increase from last year.
don't go negative.
Right, and that's why you see the thin red lines go flat for a while, because that's when you're failing the test by more than the adjustment.
So for some years, we have a target percentage adjustment of 3%. You're not a full 3% below inflation. You might be. You just depending on the inflation, you're just at level.
Yeah, think of it this way: you never take less than you did in the prior year.
Right. Okay, that's another thing.
Yeah, it's never take a pay cut. That concept. And other researchers, looked at withdrawals. They said, a lot of dynamic withdrawal strategy research shows withdrawals going up and down, and I just don't think that's realistic in the context of a financial planning relationship. Clients don't feel the need to take this inflation increase. That's where the papers are done. I'll take the same thing they took last year. Over time, they're going to have to start, because, theories, you have 2/3 loss of purchasing power, at least that's the way the historical data is.
The comment that retiree spending decreases as they get older, they must not assume anybody goes into nursing home care.
Well, right.
That increases your spending dramatically.
Right. That's true. Also, there's healthcare costs are increasing. But if you want, I saw papers in my paper. I want to go read the research. But they basically say that people, travel less, they spend on clothes, they live less active lives. They compared to the years right after retirement. Those are usually years where people have a lot of activity. That's what the studies show.
We did these Monte Carlo, do you, what do you assume? You have a mean and standard deviation around the mean. Then what do you do for the covariance or whatever between two different kinds of investments? You're probably assuming something there, right?
Well, you calculate those off the data, and there are some standard I cross-checked mine with a couple other researchers, but basically you calculate those off the data. So it's just actually there's routines that you can just submit two different theories and calculate the correlations. Basically using the historical data, which is questionable right there. I mean, it's the only thing we have. It's the best stuff we have to go on. You could argue that past performance is not an indication of the future. You've heard that phrase, and it's but it's the best data we have. And current researchers who published that article, I don't agree with that article about 4% not being safe anymore in a low yield environment. I think the flaw in their assumptions was that they assumed low bond yields. That's fine. I don't have any problem with that because bond yields probably won't go up for a while. But they also assumed that the equity premium would be low or lower than it had been historically. And I don't really think their foundation for that is solid at all. In fact, look at the last few years, the equity premium is about double what it's been historically. We've been in a low yield environment for 2 or 3 years. So, empirical proof against it. One thing we learned from being in pensions is that small differences projected over many years look dramatic. And what you also learn, though, is that predictions are less meaningful the farther you go out. I don't think that they appreciate those dynamics. And I don't agree with the conclusion that's describe the title of that article.
You run a 1969 retirement rate as it's a bad year, and you want to see what happens there. Assume you can run out from the 80s and 90s and even 2000. You don't get the full retirement picture, but to see what's happening.
Right, and actually that's what Bengen did in his article to squeeze like 15 words out of the data. He extrapolated the data using averages. This is an approach because the first 15 years are the most critical, as we talked about anyway.
Right.
So,
what sort of impact would jumping a 95% confidence rate up to 9 be?
I don't have that data in front of me, but well, obviously it would be a lower withdrawal rate. It'd probably go pretty low. I think that I'll say a couple things about that. Number one, a lot of financial planners use Monte Carlo. Okay, they use it in CAN programs that do retirement projections, and they often use 7% confidence. Common. That's considered a pretty good confidence level. The papers that I saw.
You come talk to a bunch of actuaries.
Yeah, right. The paper that I saw, the papers are starting to use more like 90 lately. I kind of like 95. It's statistically, highly confident. It's considered, benchmark 95%. But the problem is that these withdrawal rates are, by people, they're pretty low already. 4%, they go, gee, that's all I can take? I got to have 25 times that to retire? So you start going to 99%, now you're down to 3. Can you really tell clients that they can withdraw 2.5%, 3% of their portfolio each year? That's a little hard sell.
Would it be more likely that you would make further adjustments maybe partway through retirement as opposed to trying to have 99% confidence?
That's the principle. Yeah, that's the principle. Basically, there's now this hot topic in the field of, is 4% safe anymore? So people arguing, one side or the other. But I could describe what I thought was the consensus, which is they all disagree whether it's 3%, 5%, but they all agree that you need to monitor going forward. That seems to be a consensus. So at least we have common ground there.
That's a comment. I know there's some pretty complicated ways that you can monitor and adjust throughout retirement, but this seems like a kind of a beautiful, simple way of looking at it.
I had a whole bunch of prototypes before I came up with this one, and there are some wacky ones on in the research papers. Actually, that's one of the best techniques. Did a set of Monte Carlo simulations each year to see what your stability was for the remaining 30-year period, and decided what to do based on that. That'll work. This is and my method was, if you got to read through the paper, you could see my method actually encompassed that method and summarized that method.
So you take that into consideration, like large one-time withdrawal, couldn't you have an amount enough to where if you keep your spending level, you said the minimum would be last year's amount. If you took a big enough distribution, would that crash your portfolio eventually?
Well, the idea being that what you would do is, so you monitor the portfolio, is you what withdrawal is, and by the portfolio. That's what I call your current withdrawal rate. Okay, and that is by definition moving object. And even if you are able to achieve your goals, it will over time. So when I say you can take a one-time spending opportunity, what you do is you subtract out from your portfolio in the denominator and see what your withdrawal rate would be after you spent all that money, and you'd compare that to your target, and you'd see it's a measure, it's a benchmark to say, okay, well, I'm still target, which would be passing, rather than being, it would put me above, which would be failing. Or you could say, if it put you above, how much would it put you above, and could I afford to take that risk? It's a means of doing what all these research say you should be doing, but don't give you the tools to do. They say you monitor your report. It's like, ask your doctor about this, new drug. They don't tell you how to do it. So what I'm trying to do is give some tools to be able to do monitoring, not but also financial advisors, tools for financial advisors for their clients, and to make those decisions.
This is a little bit away from model per se, but you start out with the premise of these doomsayers that we've got this perfect storm coming, and they're saying we've got high equity valuations and we've got low bond yields, which implies high bond prices, and of course you're getting absolutely nothing in a money market. So basically, what are you supposed to be in then? I mean, if the stocks are overpriced, the bonds are overpriced, and you're not getting anything from cash, I mean, it's like, you got to put your money somewhere. So I guess I challenge that premise of this perfect storm, because there's no win situation if you.
Well, the premise of the perfect storm is that is not where to put your money. It's whether 4% is safe or not. Okay. The premise of the perfect storm is that it argues that in this paper, if you look at this paper, it was available on the internet, they're basically saying that 4% has a 50% success ratio today, something along in the neighborhood, using their assumptions. Okay, so what they mean about perfect storm? It's a perfect storm, or that's my term, really, perfect storm. But they're saying that the current environment is not friendly to the 4% yield rate. Their predictions of the future, which is where I lose. Yeah.
So where do you put your money?
Real
question. In your mattress.
Can I disclaimer?
I've also heard theories about controlling the being better control of our expense side, so that you can, now you got to eat, you got to have a minimum of clothing and be able to move around and stuff like that, but you might be able to control that vacation you took every 6 months and bring it down to once a year or once every 2 years, and that would enter into these planning for retirement as well.
Yeah, there's been a lot of stuff on that. Financial planners use an approach similar to that. Basically, your needs, your wants, and your luxury items, and different buckets, and maybe invest money differently for different things. I don't use that approach, but it's a commonly used approach. I just think of it the way that I have it here. It's a simpler concept.
Do this thing for a short period of time, and let me explain to you what I'm thinking of. There are currently available or will soon available these longevity annuities, which start out at, let's say, age 85.
Right.
So take care of my needs from 85 on. Of course, lose some of the money that goes into this model right from the beginning. But then what's behind, you need to run it for 20 years, you know. And I'm sure it would change some of these numbers much or whatever. But, you know, now it's totally clear to some extent how long to live, because that 85 plus annuity will take care of that end of the...
Well, keep in mind, there's been a lot of discussion on that in the financial planning field on that. There's a website by an actuary who publishes an index that uses that model. But find that it has to be an inflation-adjusted annuity, which makes it even more expensive, you know. Also keep in mind that, you know, when you buy an annuity from an insurance company, you're just buying bonds, you know. So you're not going to get. So you're basically going to pay these worst case rates, or something less, maybe even less than these worst case rates, because these worst case rates have the equity premiums. The equity premiums built into them up. So I think that was an index. I think he argues you could do about 4.5% with a portfolio. He reposts it monthly.
So how much should we be saving? Just off the topic.
25 living expenses.
With ultimate goal.
Or maybe 20.
Yeah, between 20 and 25, yeah.
Of your living expenses that you expect to have when you're retired.
Right.
And that I just want to promise you that on the models, there was $1 left over that you're talking about. I'm going to give that to you.
Yeah.
Hey, Dave Zolt, this is John Weber in Charlotte. I got a question for you.
Hi, how you doing?
I'm doing well. How are you? Good to hear from you.
Good.
Thanks a lot for taking the time to come out and make this presentation. You know, it's very relevant to us on the DC side of the business, where you know, you convince people to save enough to last through their retirement. Which, you know, once you get them into the plan, that's the challenge, is make sure they're saving enough. How do you commercialize this idea? Take it into a usable tool where an individual can understand and monitor their withdrawals through retirement.
Yeah. Well, I don't really know the answer to that question, but I've thought about it. And one of the reasons I decided to write the paper was that I decided that I'm not interested, or I'm not expecting or interested in making anything off of this idea. It's basically my contribution to the field. I see it as kind of philanthropic. It's my gift to the field. And the reason I trademarked the target percentage and the target percentage adjustment is that in case somebody else, particularly a large company with lots of money, decides to try and commercialize it, and
they get money off.
They have to come to me to get the rights to it. And that's as far as I thought about it.
So by publishing the research, you have you have to trademark your research then? And I'm just ignorant from that standpoint.
Yeah, I don't know all the rules, but I've been told that by putting that TM next to the target percentage on the slides and in the article, that tells the world that I've claimed it as my trademark. I haven't filed it. I may file it at some point, you know, a couple $100 or $1,000 or whatever. I haven't decided whether I'm going to do that yet. I think I have time to do that.
Yeah, I don't think Hamner's on the phone to give you some personal advice, or some legal advice, but you do have to file it to protect it or something. So. Well,
it's kind of like copyright. You with a copyright, when you write an article, you have the copyright, but if you file it, you're a little better protected.
Yeah. Okay.
Well, thank you so much for Assume that there are no other questions. It's going to take us, at least me, a while to digest this study, but the people in the room are smarter than me. They already figured it out.
Yeah, we knew that.
That's
Thanks
great.
for having me.
Thank you.
It's been fun.
Thank you.
All right. See you, everyone.